as we often do, let's start with you for the state of play, and let's put in context just how much of a blowout this number really was and what the expectations could be.
All right, let me start at the bottom. The bottom is we're adding 100,000 workers demographically every month. We were looking for 185. So we got 353. You can see we did more than triple what's needed to put those coming into the workforce to work. And I don't know what you want to call it, just for fun, call it nearly double what the expectation was. I think a piece of this was seasonal adjustment. We've had 4 blowout Januaries in a row. But then you put the revisions together with that, Dom, and I do see some serious strength in the job market here, along with the higher wages that I think is worth putting into context. I will say this. I think it's interesting, Dom, and you're more of an expert at this than I am. The way the market reacted, it's like, oh, my God, strong jobs numbers. The Fed's not going to cut. But wait a second. The jobs numbers are strong. People have a lot of money. Earnings are doing well. And then the market seemed to take the other side of that trade as the day went by.
Yeah, Steve, it sure doesn't feel like a recession, whether one's coming or not or otherwise. Maybe Michael Gapen, let's turn to you. You're the economist. This number compared to what you thought, I had spoken at length over the last week or so to a hedge fund manager who had his own models about what the jobs number would be. And to this source, who will stay anonymous, he got it pretty close to this. He was expecting a blowout number. How much of this was a surprise for the economist community writ large?
Well, I think, like Steve said, it's double what economists were estimating. So there is a big upside surprise here. I do think some of it is related to seasonals, as Steve mentioned, that we're just not laying off as many workers on a post-holiday basis. So some of this is a little noise, not signal, but it's hard to argue when you look top to bottom across the employment numbers, the wage data, and so forth, that the labor market isn't in a very strong position. It is. So there's some noise versus signal argument here, but the message seems to be clear.
Where is the message, Michael, with regard to the inflationary context that this jobs number puts the economy in? Average hourly earnings still up roughly 4.5%. I think it's 4.6% over the same time last year. A 19-cent per hour pickup over the last month, 0.6%. Does this then mean that inflation is creeping back, or is this just a little bit of noise, as you point out, that it could be something that we smooth over the course of the next several months?
Yeah, and also it could be something that gets eaten up in margins. For example, if consumers are price sensitive and don't want to continue to purchase, if overall final consumer prices are going up, maybe this ends up as a margin story. So yes, it does. If wage growth is running above what the Fed thinks is consistent with 2%, it will increase their concerns that inflation is not falling sustainably to 2%. I think they'd like to see wage data more in the 3.5% range based on where productivity has been going on average over a longer period of time. So I think this would raise concerns for the Fed about the sustainability argument and why they need, quote, greater confidence that inflation's subsiding before they begin a rate cut cycle. So I do think it'll keep concerns about services inflation elevated.